In this presentation, I'm going to show you how to calculate the discount on a notes receivable and how to allocate its interest expense. So let's look at the example here where we got 4 equal payments at the end of each of the next 4 years for either notes receivable or payable. And what we have to do here is we have to discount these 4 payments back to their present value at the beginning of year 1 here. So we do that, did that through an Excel function here, and we determine that those annuity payments discount back where their present value was $3,170. So that represents our principal amount here on our notes receivable or payable. Now we will receive 4 equal payments of $1,000 for a total amount of $4,000, and then we subtract out our present value of those payments, $4,000 minus $3,170, and we get interest revenue or expense that we have to amortize over that notes payable or receivable, and in this case it would be $830. So let's go up here and see how we do that. So in our amortization schedule here, we would start out with a beginning balance of $3,170. Now that's the present value of the notes receivable or payable, and then for the year we would pay 10% interest on that balance here. So that 10% times 3170 gives us $317 worth of interest for the year. Now we had a payment, either receipt or payable here, of $1,000 at the end of the year, end of the first year. Now that payment includes the interest receivable or payable plus its principal portion of that payment. So if we subtract here the interest from the payment amount here of $1,000, we end up with a principal amount for the year of $683. Now we reduce that beginning balance here, the beginning of year 1, by that principal amount that we reduce our notes payable or receivable by for the year, and we end up with an ending balance of $2,486. So this ending balance becomes the beginning balance the next year, where we calculate our interest expense by taking 10% times it, and we get an interest expense here, or receivable or payable, of $248. Now if we subtract that interest portion from the payment amount, we end up with the principal for the year that we're going to either receive or pay. So we'll take this principal amount subtract that from the beginning balance, and we end up with the next year's balance here in the principal, and then we just continue on calculating our interest and then subtracting that interest from our payment amount, and then we reduce and include that as the balance. The difference would be the principal here. So when we end up with this accounts receivable or payable, we have made 4 payments here, and when we've accumulated our interest here of $830, and then we've had an accumulated amount of principal paid, and that leaves us here with a balance of $0 on any more payments that we're going to receive. So we have the $830 cumulative interest plus the $3,170 of principal paid, and that represents the $4,000 worth of payments we've made here. $4,000 worth of payments. So that's how we'd amortize the discount on our notes receivable or payable, and what we're talking about here in that discount is this interest expense here. Here I'm going to show you how to record the notes payable with a discount amount, and I have the balance sheet items laid out here and the income statement items over here. So let's look at this notes payable. We started out here with $4,000 in the notes payable, and then we received or we paid payments here of $1,000 each for the next 4 years. So we reduce notes payable by those $4,000 worth of payments, and then we credit cash here for $1,000 payments paid each of these 4 years. And we have to go down here and record a discount to notes payable. Now that's a contra account to notes payable, where it reduces the notes payable amount, and that's calculated here, where this discount represents this interest expense that we had to allocate here. So we have the $4,000 worth of notes payable here, and then we factored that back here to its present value at $3,170, and then we had this $830 worth of interest, and that's what this discount represents here. Now this discount to notes payable gets reduced each year by the interest that we paid on it here. So at the end of the fourth year, the discount here is reduced to 0. Now the balancing entries here would be to our notes payable expense, and those we started out here in year 1 where we recorded the $3,170. That would be the present value of these notes payable, and then each year we had that interest expense on the notes payable here. And when you add the $3,170 plus the interest expense, you've got $4,000 here of notes payable expense. Now that balances here with our notes payable. So just looking back here, the on this interest expense, that amount here represents this interest that we had to allocate between the $4,000 worth of payments less their present value. So we recorded here the present value of the notes payable, and then the interest expense, and that was the $4,000 that you're looking at here. Okay, this is just the journal entries and how you'd handle a notes payable where you have a discount on this notes payable.